So, for my talk today, I'm going to focus on financialized landlords and its implication for Black renters. So, kind of a little bit about how I got started with this project is it's sort of an extension of my PhD work, where I looked at the U.S. foreclosure crisis and looking at the way that it impacted the African American community in both Chicago and Jacksonville, Florida. And from there, right after a lot of Black households were losing their homes, a lot of private equity firms, hedge funds, and asset management firms were coming in and acquiring a number of these properties within these communities. And so I was interested in knowing if these particular strategies were happening in Toronto. So this picture is of an apartment building that is not too far from where I grew up, in the Eglinton West community, which is also the site of the new Eglinton LRT line. So this particular property, which is 2 Glenhaven Street, which is just east of the intersection of Keele and Eglinton. And so this particular property, just I think maybe in 2012, it was acquired by an asset management firm called Shelbourne Capital. And literally within 3 years, this property was then acquired by Starlight Investment, which is a large asset management firm here in Toronto, which Martina had spoke about in her presentation earlier. So to get into, sorry. So I'm not going to get into so much of the definition because Martina has already gone over it, but one of the things that I wanted to stress is the fact of how housing is now being valued for its exchange value rather than its use value. So for this particular presentation, I'm going to be focusing on Black renters, as I mentioned, but more specifically with a focus on the former borough of the city of York, which I mentioned. A lot of landlords have been acquiring a number of properties within this particular community, largely stemming from the news of the construction of the Eglinton LRT. So like many residents in this community, I was super excited to learn about the Eglinton LRT coming into being constructed in the community, largely because of how it would help to connect connect this community to the rest of the city. But also, I thought that it would be a huge benefit for some of the small Black businesses within the area itself as well. And so sorry, I don't know why this is. Okay, so this is sort of a map showing the concentration of institutional landlords in the former borough city of York. And as you can see, a good chunk of the concentration is to the north along Western Road, all the way close to the 401. As you can see, another set of concentration along Eglinton Avenue West to the Allen, and then south of there from Vaughan Road, Vaughan and Oakwood, all the way down to Bathurst and St. Clair. And so much of these transactions have been dominated by asset management firms such as Starlight, Timber Creek, and 3 interesting firms: the Canadian Pension Plan, and also an insurance company, Great West Life, and Minto, which is another institutional landlord in the market. And as you can see within the market since 2007, a large number of transactions have been taking place. So this is a graph showing, a chart showing the transaction. As you can see that there seems to be a huge spike in 2015, and those transactions are representative of the large acquisitions from Great West Life, the Canada Pension Plan Investment Board, and Minto Group. But also, as you can see, there was another spike in 2019, which is largely representative of the transactions that were made within the community by Starlight Investment, and currently this year they've made a number of transactions as well, along with Timber Creek within this particular neighborhood. So this shows the number of units that has been acquired per year within this particular market. There's been a lot more, but what I did was I limited the data to only capture landlords that have acquired either greater than 20 units, but also I've limited the list to represent some of the much larger landlords within the market itself. And as you can see from this particular chart, which I mentioned in 2015, I'm not sure what the reason is for that spike, which is kind of the reason why I'd like to look into that more, of why there was such a spike in this community in 2015, 2019, and a little bit in 2020. As you can see, in 2019, Starlight acquired 946 units in the market, and in 2020, they acquired 188. And some of these transactions were also done through a joint venture with Blackstone Group, which is one of the world's largest private equity firm, which is based in New York, and they used to be one of the largest landlords in the United States through their subsidiary Invitation Homes, which was the largest landlord of single-family properties in the United States, but they since sold off their interest in that particular company, and they've been going to other countries and doing similar activities in places like Europe, like Berlin, and other in Barcelona and in Madrid. And so, as I said, two entities that I'm going to be focusing on for the research that I'm doing in this particular community is Timber Creek Asset Management and Starlight. And as you can see from this particular chart, the number of acquisitions from 2013 to 2020, as we spoke about earlier in the previous chart, with respect to the large acquisitions that were made in 2019, which is also a representation of their acquisition of Continuum portfolio. I believe it's Continuum's multifamily portfolio in late 2019, and which had a number of properties within this particular community itself. But one particular in that portfolio was two large towers at the just south of the Western Road in 401. I can't remember the specific address of it, but that represented a large chunk of the units that they acquired in 2019. So where a lot of these entities are getting their funds from are public pension funds who have invested heavily in private equity firms, asset management firms. For years, pension funds have been having a shortfall in terms of funding and not being able to, and not having enough money to actually make payouts when individuals are at the age of retirement. And as a result, to make up for those funding shortfalls, they've increased their investments in alternative asset classes like private equity firms and asset management firms in order to bridge that gap. So about 2 decades ago, these particular asset classes represented about 7% of the pension funds portfolio, and today they represent upwards of almost 30% of their portfolio. And as you can see, a number, not just only pension funds that are heavily invested, but also university endowments. And for one particular endowment is the University of Toronto Asset Management Corporation, which is heavily invested in the private equity firm Blackstone Group based in New York. So one of the ways that these particular companies, as Martine talked about earlier, in the way that they're able to squeeze rent out of these particular buildings is through through the provincial rental guideline increases, but also identifying operational inefficiencies, so unlocking untapped values. As Martine talked about, sub-metering different units. And one particular example that I'd like to highlight is in this area, there are a lot of properties that have unassigned parking parking spaces. And so one way that they've helped to sort of bolster their bottom line and increase their revenue is by going into these parking lots and drawing lines and putting some numbers down and assigning parking spots to different units as a way to help increase their revenue. Another way that they've also identified inefficiencies is getting rid of superintendents, especially the superintendents that are living in these particular units, largely because those superintendents are not, the unit being occupied by the superintendent is not actually making them any money. So that's another unit that can be used in order to increase or bolster their bottom line. And as I mentioned earlier, with respect to higher rents and surcharges equals higher profits. But the issue with these sort of strategies is that it increases housing insecurity and by exacerbating the affordability problems in some of these buildings. So a lot of these companies strive to make a lot of their money on turnover in order to increase revenue, increase the revenue of these particular assets that they're acquiring. And as I mentioned earlier, a lot of their acquisitions are happening in racialized communities and communities with high levels of poverty, which strategies like these help to exacerbate the affordability and displacement problems. So value-added investment strategy is another strategy that, which is a core strategy of a company like Starlight, and where they engage in-suite renovations. They might make additions to the common amenities. So they might build in a parquet on the particular land itself. They might build in a pool or utilize pools that are underutilized and maybe even charged per use of the pool. They might even install or construct fitness facilities within the building itself, or engage in exterior renovations. And for some reason with Starlight, they're always for some reason coloring their buildings with a dark gray or a light gray, or with a white to sort of give this to sort of represent this newer style building, or help to rebrand the building. And so a lot of with these exterior renovations are usually paid for through above guide increases, which allow landlords to pass along any capital expenditure costs to any improvements that are made to the particular property. And these are usually happening in gentrified areas. And so these particular changes, as you can see with the picture in this particular slide, in showing the sort of shift and the changes that are happening within these particular properties. So this is one particular property in where Starlight actually acquired this property from Achilles, which is a Swedish-based asset management firm who used to own this property, which is at 2040 Eglinton Avenue West, which is just west of the intersection of Eglinton and Dufferin. As you can see from this particular slide with the before and after picture, and how, and these are some of the non-essential improvements that they made to the particular property to help generate even more revenue for themselves and their investors. And even this is a particular ad for this particular property, and to show or to demonstrate how the sort of the rebranding that's taken place within this particular building, and how and who they're actually marketing these particular properties to attract higher income households. As you can see from this particular advertisement, that they're trying to provide condo-style living, essentially just outside of the core, but without the fees. So this is another property that Starlight owns, which is on Bathurst, just north of Eglinton. And as you can see, as Martin talked about, in terms of the exterior renovations and investments that they make. So this is a property to where they're actually changing the facing on the balcony at the moment. And for some reason, this is a very common example of some of the exterior renovations that they would make to the property itself. But it's also to give, to sort of brand again brand these properties as condo style living, and these are particular characteristics that you see in some of the downtown condos in Toronto, but also in Midtown as well. So as a lot of the deals in these particular markets, a lot of deals sort of evaporate in the multifamily sector. A lot of these companies like Starlight are now embarking on a new way of sort of helping to stimulate the gentrification of the process by also doing infill development. So land is so one of the things that they've noticed is that competing for land with private developers is a lose-lose situation for them. They're not going to be able to compete. So one of the things that they've been doing is putting forward different development applications to build either residential towers, or as you can see in this example, which is another property that they own on Bathurst, again, just north of Eglinton. There's an application that has been submitted to build 32 residential stacked townhouses on the land of this particular property. So for them, the land is coming at zero cost because they've already acquired the property itself. So this is them also maximizing the best use of the land by, again, building on the land. So the fear is for a lot of residents in the community, the fear of gentrification. In this particular case, where this property at 1801 in 2014 was acquired by Kingset Capital, and this is a property that's comprised of about 50, I believe 51, but in the application it states that there's 47. But right now there's only plans of just replacing the 47 units with respect to this 30-story 280 unit development, which is kind of the big problem as well, is that we're losing affordable rental units at a much faster rate than we are replacing them. And so this is another indication of some of the issues or some of the problems that have taken place with this large infrastructure development along Eglinton Avenue West. And just maybe 2 years ago, or last year, they just actually finished completing a condo at the corner of Eglinton Oakwood, which is a telltale sign of what's to come ahead for this community. So how do we address these particular issues? I think we need to get rid of vacancy decontrol. I think with vacancy decontrol, it helps to give this illusion that rent control doesn't work. But what it does by allowing landlords to increase or maximize the rents upon turnover. So as units, as Martine articulated earlier, as units upon turnover, landlords can actually charge whatever they want upon turnover. I think we need to amend above guideline increase right now, largely because it essentially incentivizes landlords to engage in non-essential improvements to the buildings and then passing along those costs to the tenants. So I think one way of us addressing this issue would be having tenants themselves create a board within the individual buildings themselves and allow tenants to actually vote on the work that actually needs to be done, as opposed to allowing landlords to drive that initiative. A next thing that I think that would be important is for the federal government to enforce antitrust laws to prevent an oligopolistic rental market. And this is largely because, as I've shown with the geography of the acquisition in the former borough city of York, you have one particular one or a couple of landlords that are essentially you're having a small cadre of landlords controlling the market for a given geography. And I think I think by enforcing these competitive laws would help to would help in the process of definancializing the rental market. Next point that I think would be helpful, I think we can learn from other cities such as like Berlin, who is heavily trying to fight back against the financialization of housing in their particular city. And one particular example, just last year, they blocked the sale of a 700-unit apartment building that was going to be acquired by the largest landlord in the city. And so what the mayor did was not just block the sale, but they acquired the property to preserve affordable housing in the city, and they spent about $1 billion in acquiring this property. So taking that in consideration, to where Trudeau, the federal government, has offered $1 billion to help build affordable housing across the country, but yet with this city has spent $1 billion on one property to preserve affordable housing. So it demonstrates that I think that we can do it to address the issues, to address the affordable crisis. But I think it's going to take a radical shift to definancialize the rental market. And I'll leave it there.